All right, let's jump right in. Today we're going to master process costing. Now this is one of those chapters where if you get it right, it's basically free marks in the exam. But if you get it wrong, it can cause a whole lot of problems. So let's make sure you're on the right side of that line.
So let me ask you this. What's the number one mistake that students make again and again in process costing exams? It's a tiny, tiny detail in a formula you're going to use all the time. But if you get this one little thing wrong, your entire 8 or 10 mark answer, well, it just completely unravels. We're going to show you exactly what it is in just a bit.
So take a look at this. Seems pretty straightforward, doesn't it? A classic exam-style problem. A chemical company, some raw material goes in, some is expected to be lost, and you get an output. But hiding in plain sight here is the very trap we're talking about. The whole game here comes down to one thing. How do you deal with that 5% that's expected to just disappear? That's your normal loss.
Right, first things first, Section 1, the core idea. So what on earth is process costing, and when do we even use it? Let's get the fundamentals locked in before we go any further.
So in simple terms, process costing is for stuff that's made in a continuous flow. You can't point to one specific bar of soap and say, aha, that specific bit of oil went into this one bar. It just doesn't work that way. Think industries like chemicals, paper, steel. Things just flow from one stage to the next. And our job as cost accountants is to figure out the cost at every single one of those stages.
In this visual, this is basically the whole story right here. You start with your raw materials, they go into process I. Whatever comes out of process I, along with all the costs we've added so far, becomes the brand new input for process 2. And that just keeps going, down the line. It's like a relay race, where cost is the baton being passed from one process to the next until you cross the finish line with a final product.
So here are your clues. In an exam question, if you see that production is continuous, the products are identical, and you can't tell them apart, and costs are being tracked process-wise and not by job, ding, 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 you know for sure you are dealing with a process costing question. It's that simple.
All right, let's move on and build the engine room of this whole topic. This is the process account. It's the ledger account where all the magic really happens.
And honestly, it's super simple. Just think of it like any other T account you've ever made. On the left side, the debit side, we just collect all the costs. All the materials you used in that process, the wages for the people working on that process, any other direct expenses, and of course, a fair slice of the factory overheads, like rent and power. Everything gets debited to the process account.
Okay, everyone, listen up, because we're now entering the most critical part of this chapter. Section 3, losses, gains, and their treatment. I'm telling you, this is the exam hotspot. This is where ICAI loves to set its traps, and it's where you can either secure easy marks or lose them very, very quickly.
This slide is absolutely everything. You have to know the difference. Think of it like this. Normal loss is like spilling a tiny bit of flour when you're baking a cake. It's expected, it's unavoidable. So the cost of that spilled flour just gets absorbed into the cost of the final good cake. But abnormal loss, that's like dropping the entire cake on the floor. That's not normal. You can't just add that cost to the other good cakes. No way. That cost is a pure loss, and it goes straight to the costing profit and loss account. This is absolutely crucial. Mix this treatment up, and you've lost marks for sure.
And here it is, the big one. The number one mistake we talked about at the very beginning. Look at that formula. Everyone remembers to subtract the scrap value of the normal loss from the numerator from the total cost. But what do they forget? They forget to subtract the normal loss units from the denominator. This is so important. The whole logic is that the cost of normal loss must be borne by the good units only, so your denominator must be the expected good output. If you forget to remove those lost units, your cost per unit will be too low, and if that's wrong, your entire answer is wrong. Game over.
But hey, what happens when things go better than planned? You expected to lose, say, 100 liters to evaporation, but you only lost 80. What's that 20-liter difference? Well, that's an abnormal gain. It's like an unexpected bonus, maybe because your workers were super efficient or the material quality was better than usual.
So how do we value this unexpected gain? Here's the simple rule. You value it at the exact same cost as a good, finished unit. That's it. You use that exact same critical cost per unit formula we just perfected. No new calculations, nothing fancy. An abnormal gain unit is valued just like a normal good unit.
So far, things have been pretty neat and tidy, right? Units are either fully complete or they're lost. But in the real world, it's not that clean.
what happens at the end of the month when the whistle blows and you have thousands of units that are, well, half-baked? That's your work in process, or WIP.
So what do we do with them? We've got thousands of units that are, say, 60% complete for labor or 70% complete for materials. We can't just ignore them and say zero work has been done, but we also can't pretend they're fully finished. So how on earth do we account for their cost accurately? Well, there's a really clever solution for this.
And it's called equivalent units. This concept is brilliant. All it means is we convert that partial work into a whole number of units. So listen to this. If you have 1,000 units that are 80% complete in terms of labor, that's the equivalent amount of work is completing 800 units from start to finish. See? 1,000 units times 80% equals 800 equivalent units. It's just a way to measure the total amount of work that we've actually done.
Now, whenever you see WIP in a question, don't panic. There is a 5-step system that works every single time. This is your safety net. First, analyze the flow of physical units. Second, calculate your equivalent units. Third, find the total costs for each element. Fourth, compute the cost per equivalent unit. And finally, you apportion those costs correctly. You follow these 5 steps in order, and I promise you will nail the question.
All right, we're at the final boss level of this chapter, valuing that work in process. Now, ICA will ask you to use one of two methods, FIFO or weighted average. You don't get to choose which one you like better. You have to know both of them inside and out.
And the difference between them is all about the underlying assumption. Think of FIFO, first in, first out, like a queue at a ticket counter. The units that were already waiting in line at the start of the month get finished and sent out first. It keeps old costs and new costs totally separate. Weighted average, on the other hand, is like making a smoothie. It takes the old costs from opening WIP, throws them in a blender with all the new costs from this month, whizzes it all up, and pours out one single average cost for everything. Two totally different philosophies.
Okay, theory is great, but let's see this in action with an actual example. We're going to break down how to value output using the FIFO method, because it's a classic exam format. The real trick here, the part you really need to watch, is how we calculate the equivalent units specifically for that opening WIP. Right, let's really zoom in on this table, because this is a major danger zone where marks are lost. Look at that first output line, opening WIP completed. Under FIFO, the rule is you only count the work you did this period. So if those 1,000 units were already 60% done from last month, how much work did we do this month to finish them? Well, we did the other 40%. So the equivalent units of work done this month is 1,000 times 40%, which is 400. That is the critical distinction for the FIFO method. And that brings us to the golden rule for FIFO costing. When you calculate your cost per equivalent unit, you only use the costs incurred in the current period, divided by the equivalent units of work done in the current period. You completely ignore the opening WIP cost for this calculation, you get a fresh, current period only cost, and you use that to value all the work you did this month.
So, you've got the pieces of the puzzle now. You understand WIP, you understand losses, you get gains, but here's the real test. Can you handle it when ICAI throws everything at you in a single, complex question? I'm talking about a problem that has opening WIP, closing WIP, normal loss, and an abnormal gain all mixed together. That is the level you need to be ready for.
So let me ask you something. How is it even possible to have profit tied up in your closing stock? I mean, you haven't even sold the stuff yet. It feels totally wrong, right? Well, my friends, this is one of the all-time classic traps that ICAI loves to set in process costing problems. But don't you worry, by the time we're done here, you'll see it coming a mile away and know exactly how to handle it. All right, first things first, the inner process profit trap. So why does this even exist? Well, imagine a giant company. Management wants to know if each department or process is pulling its weight and being efficient. So they treat each process like its own little business. But this makes things tricky for us, especially in an exam. Here's the core idea. One department doesn't just hand over its semi-finished goods to the next one. No, it sells them at a profit. This price it's transferred at isn't the true cost. It's the cost plus a bit of profit. And that extra bit, that's what we call inter-process profit. So yeah, it's great for managers to see who's doing a good job. But look at that second point. That is the exam trap right there. It creates this huge problem where your closing stock value is inflated with profit that you haven't actually earned yet. It's unrealized. You simply cannot claim profit on stuff that's still sitting in your warehouse. Adjusting for this is where so many marks are lost. Okay, enough theory. The best way to master this is to get our hands dirty with a real ICAI-style problem. We're going to break down illustration 6 from your study material, piece by piece. Let's make this crystal clear. So, here's the data for our problem. We've got two processes, a finished goods account, opening and closing stocks, all the usual costs, and, most importantly, those profit percentages on transfers. I know it might look a little overwhelming, but trust me, we're going to take it one account at a time. It's totally manageable. Let's kick things off with the Process I account. See those three columns? Total, cost, and profit. Using this structure is non-negotiable. We start by putting all our costs on the debit side, opening stock, materials, wages, and overheads. Now, for Process I, it's simple because there's no profit element from a previous stage, so the total and cost columns are identical. Now, stop. Everybody focus. This is so important. The question says profit is 25% on transfer price, not on cost. This is a classic ICAI twist to catch you out. Now, if profit is 25% of the selling price, that's 1/4, right? Then the cost must be the other 3/4. So to find the profit, you take the total cost and multiply it by 25/75, which is the same as just dividing by 3. Please, whatever you do, don't just calculate 25% of the cost. And here's how it all comes together. First, we figure out the total cost ready for transfer. That's just our total debits minus the closing stock, which gives us $40,500. Now, we use our magic formula. Divide that by 3. Boom! Our profit is $13,500. Cost plus profit gives us the total transfer price of $54,000, which is now heading over to Process 2. Okay, 1 down, 2 to go. Let's move on to Process 2. Now things get a little more interesting. The big challenge here is dealing with the profit that's coming in from Process 1 and the profit that's already sitting in Process 2's own opening stock. So on the debit side, first up is opening stock. The question tells us the total value is $9,000 and that includes a profit of $1,500. So we have to split it. $7,500 in the cost column, $1,500 in the profit column. Then we bring in the transfer from Process I. Total $54,000, which we know is $40,500 of cost and $13,500 of profit. Then we just add this process's own materials, wages, and overheads. Whoa, hold on. Another huge exam trap alert. Read that sentence carefully. Stock in processes is valued at prime cost. Prime cost? What's that? Direct materials plus direct wages. This little instruction is a game changer. It means our closing stock value of $4,500 in Process 2 is only made up of prime cost. It has 0 overheads and 0 profit in it. If you miss this one line in the question, your whole answer will be wrong. You have to read every single word. So with that sorted, we can finish the Process 2 account. We get our total cost, we subtract the closing stock valued at prime cost, and that leaves us with the cost of goods ready to be transferred. Now the profit here is 20% on transfer price, so that's 20/80, or 1/4 on cost. We apply that, find our new profit, and the grand total gets transferred to finished goods. And here we are, the final step, the finished goods account. It's the same logic. We bring in our opening stock and the transfer from Process 2, splitting both into their cost and profit components. The really critical part here is valuing the closing stock. The question gives us a specific way to do it. We use a proportion formula to figure out the true cost hidden inside that closing stock value, which lets us figure out the unrealized profit. The final balancing figure is our cost of sales, and that profit column shows us the real, actual profit we made on our sales. Okay, take a deep breath. We have officially cracked interprocess profit. Now, let's quickly switch gears to a related topic you might get a short question on, operation costing. So what's the deal with operation costing? Well, think of it this way. Process costing is for when you're making a million identical things, like bottles of Coke. You just average the cost. But operation costing is a hybrid. It's for when the basic process is the same, but the ingredients are different. Like a car factory making both a standard model and a luxury version. Different leather seats and engines, but they all go down the same assembly line. So the key thing to remember is this. With operation costing, you track the material costs for each specific batch, but the conversion costs, labor and overheads for running the machines, those get averaged out over everything that goes through that operation. You see this all the time in industries like clothing. The fabric for a cotton shirt costs less than for a silk one, but the cost of the sewing operation is the same for both. Fantastic. We've covered the heavy lifting. Now, to make sure this is all locked in for exam day, let's do a quick fire revision of a few key terms and then test ourselves with a couple of MCQs. Let's breeze through these. Normal loss, that's the spoilage you expect. Its cost just gets absorbed by the good units. Abnormal loss, that's when something goes wrong unexpectedly and it goes straight to the costing P&L. Abnormal gain, that's a nice surprise when you produce more than you expected. Also a P&L item. And equivalent units, that's just our clever way of valuing unfinished work. These are the building blocks for any process costing question.
Okay, first question for you. You put 200 units in. You expect to lose 20, but you only get 150 good units out. What's the situation? Take a quick second and work it out.
So, how'd you do? The logic is simple. Your input was 200, your normal loss was 20, so you expected to have 180 good units, but you actually only got 150. That shortfall of 30 units, that's your abnormal loss. The answer has to be C. All right, next up, a concept question. Why on earth do we go through all this trouble with interprocess profit? What's the fundamental reason we do it? Think back to what we said right at the start. And the answer is C. The whole point of this exercise is to measure how efficient and profitable each individual process is. It's about turning each department into its own mini business so management can see how well it's performing. And that is a wrap. We have taken apart the interprocess profit trap. We walked through a complex problem, and we've clarified operation costing. You are now equipped to turn this potential minefield into a certified gold mine for marks. So the final question is, are you ready to spot every hidden profit and trap in your next process costing problem? I think you are.